Barolo, it's like YOLO, but better.
A neighbor just threw the newspaper at my door. What kind of service is that? Huh? Can't get a courier that's that good.
Very aggressive.
Got the Barolo out?
I drink too much Barolo. Hey everybody, welcome back to Pardon the Price Action. I am JC Parets, and as always, I am joined by Steve Strazza. Let's get right into it. Chemicals. We continue to see cyclical stocks pop up on our scans. What stood out recently?
Well, it's been going on for a few months now, right? Whether it's young aristocrats or minor leaguers, most of the bottoms up scans that even include cyclical stocks, it's been dominated by mostly financials and energy. Saw it again this week in minor leaguers. But in Inside Scoop lately, also, we're seeing a lot of insiders kind of, show some interest and put some money behind some of these cyclical themes that we've seen playing out. Most recently, the one that stood out is Huntsman Corporation. It's a chemical stock. Starboard Value, Jeff Smith took an activist position in it. They're fighting right now over like board seats and all that stuff. Usually when you see an activist position like this, the stock's kind of beaten up. It's a value stock. Not this time. The stock's breaking out of a multi-year base. It's at new highs. So there's a lot to like there. And then you have that catalyst on top of it. You could define your risk right at those 2018 highs. We talk about that a lot.
I like the Corteva. This is a name that popped up on a different scan. We've been looking at this name just because of the base. It's an Indianapolis agricultural inputs company. So it's just popping up on our new highs list, things like that. And then boom, all of a sudden, some serious action on this on the Corteva, CTVA.
Yeah. Like a fertilizer stock. And that whole space has been red hot too. A lot of new highs over there.
Yeah. Nutrient, same thing, right? It's been a big winner across the board. And then as you mentioned, a lot of these agricultural names, natural resources in general, energy, financials, they're popping up on a lot of our scans, not just one. Here's the minor leaguers report. This one's specifically natural resource stocks, of course. And then in the Inside Scoop, what are you seeing? Seeing a lot of oil and gas, midstream, things like that. All right, on you.
The T&E trade, leisure, lodging, entertainment, and other reopening names are all over the new highs list in recent weeks. Are you buying this theme?
I mean, what's there not to like? A lot of these things are looking really, really interesting. You're looking at the peak from 2020, right before the COVID collapse, if you will. The fact that we're above those levels, I think it's encouraging. And in a lot of these cases, we're making multi-year highs. So after consolidating throughout pretty much the most of last year, we're now potentially getting breakouts, and the risk versus reward is very well defined in these areas. So I don't really see anything not to like. If you're looking for strength, look at Golden Entertainment, GDEN above 54, target up above 85. Again, the risk is well defined because you know that if you're back in that range, you don't want to be in it. It's a little too messy. Look at the old price line, Booking Holdings, BKNG, also popping up on our Hall of Famers scan. Also pushing up against new highs. Really, really interesting. I know you're excited about it.
Yeah, absolutely. And it's not just Booking Holdings, Expedia, which is a very similar company, also on the new highs list just today. Then also you have the hotel names, whether it's Marriott, Hilton, Host Hotels, Hyatt. They were all on the new highs list today. These stocks are breaking out. It's obviously the market pricing in people going back to some sort of normalcy, going on vacations, traveling more, all that stuff will be very good for the economy. And more importantly, bullish for these stocks.
Yeah, well-defined risk. Again, hate to keep harping on that, but I really like that the best. Like I get like the theme, I get the rotation, like all that's great and everything, but what's the risk and then what's the potential reward? And in a lot of these cases with Hilton, if it breaks out above 159, 160, you look at Marriott already working, making new highs, gave us well-defined risk a few months back. But the bottom line is the risk. That's really what it's all about. Like, great, it's a great story. I'm rooting for these stocks. I never found myself rooting for stocks, particularly the Hilton and Marriott, but as a member of society, I would like these stocks to be doing well because it's a good indication of things to come. All right.
Absolutely.
So base metals break out. Metals and mining stocks are making new highs. What are the implications for risk assets?
Well, first of all, XME, which is the metals and mining ETF, is making new highs. That's a great place to hang out and find some long exposure, XME and its holdings. But more importantly, this is very bullish development. For a while, it was just energy stocks kind of working from the whole commodity themed trade. Now we're seeing agriculture and chemicals, like we just talked about, and we're also seeing metals and mining stocks. What this usually happens in an environment where yields are rising, inflation expectations are rising, there's solid global growth. It's a bullish environment. So I think it bodes well from an intermarket perspective too.
No doubt about it. Look at copper futures. We've been talking about boring, copper doing absolutely nothing. But if the metals and mining ETF is any indication, and historically it has been, right? So that's not something we want to bet against. I think the stock market is telling us that the commodity will ultimately follow things like aluminum and tin that have already been working. So it wouldn't be like so out of the question for copper to break out. It would just be joining the rest of its brothers and sisters and cousins and whatnot. And then you mentioned from an intermarket perspective, we look at inflation-protected treasuries compared to traditional treasuries that have been working their way higher. So is that also suggesting that tips are looking to outperform, further emphasizing that inflation is probably here and we should be taking advantage of these? And I think you nailed it. XMEs and ETF, but look inside. Look what's inside the ETF and you're going to find ideas in there. Freeport McMoran obviously being one of them.
Oh, bad credit. Credit spreads have been widening. What is the message from the bond market these days?
Well, bonds in general are going down. And the question is, JC, junk bonds are going down. They're selling off hard. Like, what's up with that? And it's like, well, interest rates are ripping, so it makes sense for bond prices to fall. My bigger focus is on how those junk bonds are doing relative to treasuries. How's the riskier one doing compared to the safer one? Still holding this key support. Look at high yield versus treasuries right here, just holding that key support. So for me, you know, we always talk about, I don't trust a lot of people. I trust dogs and I trust the bond market. And if the bond market breaks and high yield really completes this top, what does that say for stocks? It's probably not great for stocks. So they really need to dig in here and hold on the spreads.
Yeah, you nailed it. Of course, bonds are falling, but the issue lately is that junk bonds have been falling at a much faster rate than treasuries. So that's why you're seeing, spreads widen there. And this chart really explains it all. You really don't want to see this end up being a topping formation where high yield versus treasury ratio rolls over, because that would suggest historically has a very strong correlation with risk assets and the stock market.
So I just want to reiterate, with interest rates spiking, you have to, obviously, maybe not obvious to you, but that's just how the markets work. Bonds are going to get killed. So it's really the relative. So we're looking at high yield relative to treasuries. We're looking at Spain relative to Germany. We're looking at emerging market bonds relative to the United States Treasury bond market. So we're really comparing those as those yields, as a difference between the yields, the spread, as that widens, that's evidence of stress in the bond market. And there are global macro implications to other assets, particularly stocks and commodities for that matter. So I think that whether you're trading bonds or not, like I'm not trading credit spreads personally. We have clients that trade credit spreads, but we use it mostly as a source of information. All right, next, Mr. Strazza. Talk about relative reversals here. The U.S. is the worst performing country in the Western Hemisphere this year. Wow. Is it finally time for the rest of the world to catch up?
Yeah. So my whole career, I've been hearing, analysts make the case that international stocks are cheaper. They're more, that's where the value is, and they're just bound to outperform. Been hearing this for 10 years. It's never happened, but it's been a long time that the US has been really consistently outperforming for. It's not going to last forever. And we're starting to see more and more evidence that these relative trends are reversing. US is the worst performing country in the Western Hemisphere, like you said, to kick off the year. And we're seeing areas like Brazil, emerging markets, ex-China mostly, Canada, a lot of countries with exposure to cyclicals doing really well and outperforming. So it seems like that's definitely where you want to hang out for now, is in those relative leaders, and pay attention to these relative trends, because it looks like this is a sustained trend reversal that's underway for ex-US stocks over the US.
Yeah, and I hear people that are like, oh, JC, I only trade U.S. stocks. It's like, why? Because those were the best performers over the last decade, and you can't overcome your home country bias? Or is it your recency bias that you can't overcome? Or is it a healthy dose of both? And I see that amongst my friends, amongst, our clients are more global minded, I like to think, and they certainly proven that. But just your everyday traders, they think domestically, particularly the American ones. But isn't this outperformance of countries around the world over the United States just a function of higher interest rates and the fact that, you know, the US has so much growth and a lot of these countries around the world are more value oriented? I mean, look at some of these names: Brazil, look at Saudi Arabia, Qatar, you know, the UAE, you know, UK, which has, you know, almost no growth. You know, you're really seeing a lot of these more countries that have more exposure to energy, financials, basic materials, industrials really outperforming. And you see it in this table. Such a bifurcation. NASDAQ's down double digits this year. S&P's down 6. And you got Brazil putting up a 17 spot. Huge bifurcation. Thanks, bond market.
Yep. And like you said, whether it's growth over value or US over world, it's very much the same trend. So you'd expect them both to reverse at the same time. So you could look at one another as supporting evidence, right?
Totally. Yep. 100%. Let's play a little game.
Okay, this is a game that we like to play where we say the first word that comes to mind. You're going to love this one. Fed minutes.
Waste of time, right? Even Willie Boy today, he's like, you know, guys, as much as I love the Fed, I hate the Fed minutes. And this is Willie to say that. So, you know, I wasn't sure whether Fed minutes were something that you consumed by listening to it. In my head, like it was like a podcast. I don't know why I thought that. Or it was something that you like watched. As it turns out, it's something you were to read. If one was interested in consuming said minutes, you read them. So that's something that I learned today. And in my opinion, and in the opinion of my colleague whose opinion I respect very much, Mr. Willie Delwich, he says ignore it completely. It's a waste of time. Shout out Willie.
Yep. So I don't read them either, but apparently someone did. The market read them. And the market was pricing in, if you look at the Fed Watch tool and Fed Fund futures, the market was pricing in basically a 99% chance of a double rate hike to kick off this, you know, rate rising cycle or rate hike cycle in the March meeting. And that fell to 50% today. So whatever was in those minutes, now the market only thinks there's about a 50% chance of a double rate hike. So we'll see.
And that's really what I'm more interested in, what the market is doing, you know, and not so much Fed futures, but looking at ones and twos, right? That's more my primary focus. I understand what's driving certain things, but I don't have to worry about what the Fed governor said. Is it Powell? Is it Powell? It's not Janet Yellen anymore, right?
It is not. No, it's Powell.
Ben Bernanke, that was one of the characters.
It was a very long time ago.
I remember that guy. That was a scary dude. Paul Giamatti played him in like that movie. That was really scary. I was scared.
Yeah. The financial crisis.
I knew the outcome. I knew what happened, and I was still scared.
The one about the financial crisis, right?
Yeah. Totally.
You ready
all
to do
right.
it?
2-minute drill. Energy continues to be in a league of its own. Is this leadership sustainable?
I think so. It's really starting to look that way more and more. So yep, you have crude oil, which has just been relentless. And look at energy. This is not a new thing. If you look at the XLE, the Spider Energy Sector ETF, it's been outperformed last year, and now it's kicking off this year. If you look at the Coifin performance chart, it's kicking off this year with, you know, just tremendous relative strength. Again, it's pretty much the only sector that's in the green. That's very much in the green, 20-something%. So, and then if you look at the relative trend too, you're finally getting what looks like a really nice trend reversal, a base breakout in energy relative to the S&P. So I think everything is kind of coming together, and this group is really, you know, bound to see some more outperformance in the future.
And this particular energy versus S&P, these are the equally weighted sectors. So we're looking at equally weighted energy relative to equally weighted S&P 500. So you're getting a pretty broad measure. And for you head and shoulders aficionados, you know, this somewhat looks like that. You know, call it a big base, Kardashian bottom, you know, call it what you want, but it looks like a bearish to bullish regime change, right? A bearish to bullish reversal is what it looks like to me. And when you compare energy to technology, why is the United States the worst performing country in the Western Hemisphere? It's got a ton of tech. This has so much tech that they're taking companies out of the tech sector and inventing new ones. That's how much tech exposure, right? Am I right?
And no energy. That's also a problem. No energy.
Right? So this is just another way to tell the same story that commodities are outperforming stocks, countries around the world that have more exposure to natural resources are outperforming the countries that have less exposure, the United States. And this is just another way to visualize the exact same thing in the energy versus technology ratio. And if we're back above those dot-com bubble lows, the trend is higher, Mr. Strazza. The squeeze is on, baby.
And again, like you're saying, it goes back to that value versus growth theme, similar to ex-US versus US stocks.
All right, final word. What are you leaving them with, my friend?
You basically stole my final word like I knew you would. But seeing all of the reopening names, all the hotels, the travel sites on the new highs list, I'm very bullish because that's an exciting thing. It'll be nice if people start traveling again. We could all see each other. That'll be cool. Go to some conferences.
I like it. Speaking of traveling, my final word is chicken rice in Singapore. Shout out, Singapore. We were talking about Kuala Lumpur. Strazza's going to go out there and give a presentation. If you live in KL or in Singapore, or maybe you just want to travel to KL and Singapore and say hi to Mr. Strazza, that is coming. He's gonna give a nice little presentation, and he's gonna drink too much with the Singapore slings. That's what you got to get. There's it's also this hotel or like old restaurant or something. It's been there forever. Singapore slings. You have too many of those, and then you go get some chicken rice.
All right. Yeah, you're gonna have to make an itinerary for me.
Oh, my friend Raj, he'll take you around. You'll be fine. Yeah, you're good. All right, guys. Listen, everybody. Thanks for watching. Pardon the price action. Make sure to give us a like and hit the subscribe button below so you never miss an update. And follow me at All-Star Charts and follow Steve at S Strazza. See, I got it right that time. And leave us a comment. Let us know what you think. And we will see you next week.
Peace.
Adios.